Good afternoon, wherever you might be, and welcome to Philanthropy Friday, where we profile very important subjects in the area of strategic philanthropy for advisors and for charities and for philanthropists. And we're very excited about today's session because it is a bomb. It's action packed and it's something that people, if you don't know about already, you will find out and see how much it's going to impact so many people's lives, but also what we can do about it now to perhaps be at the front end and do some preparation. My name is Mark Halpern. I'm the CEO of WealthInsurance.com. Been a professional advisor for the last 32 years. We help successful business owners and entrepreneurs and affluent families in three different areas. One is in estate planning, making sure things are organized in their lives. Second area is in tax minimization. We specialize in tax exempt insurance strategies. And the last area is in philanthropy, helping clients to incorporate strategic philanthropy into their planning to create enduring foundations and charities, often just by converting taxes into charity. Um, like our guest today, who I'm so so happy to have on, Ali Spinner. I'm very much involved in the philanthropic community, sitting on the advisory board at Sick Kids, St. Mike's, St. Joe's, TV Ontario, Humber River Hospital Foundation, and the Jewish Foundation. And it's really rewarding to learn about what opportunities there are and be able to share that, because ultimately everybody on this call are really the gatekeepers. And if we're not ahead of it and telling people about it, nobody's going to know. Just tell you two quick pieces why this is also important. Then we'll get into our conversation. Um, there's a lot of information here that just the average person just does not know about, and it's something that I'm no longer surprised about. But we did a presentation to a group of lay individuals who are involved with charities, donors, and the president of that foundation said the following at the end. They said, "Mark, I'm a reasonably successful person." He was a serial entrepreneur. And he also said, "I'm a reasonably intelligent person as well, but I probably only knew about 5% of everything you spoke about today. How come I don't know about these things? And how come our donors don't know about those things?" So that's one thing just to put in your mind, that there's a lot to know, and we need resources and we need team members to help us with our clients and donors. And the second is we work with a lot of charities. We probably engage with about 60 charities in Canada. And what happens is this is something they're very much focused on current gifts and maybe capital campaigns every 3 to 5 years. But the area of planned legacy giving and having donors incorporate strategic philanthropy into their gifts is something that really doesn't get the attention it deserves. And it's rising on the radar. So we're here as an asset, obviously a resource to help you as well. So we're very excited about it. Today, I'm very excited to have with me Alexandra Spinner, also known as Ali Spinner, who's a tax partner at Crow Soberman in Toronto. She's also the leader of the high net worth tax practice. We're going to be speaking today about the alternative minimum tax and what came down in this last budget and what we need to know about it. Ali's bio is put into the chat, and if anybody has questions along the way that they'd like answered, please refer to the chat and just plug in your questions, and hopefully we'll get a chance to get through those. And hopefully we won't have to be an entire hour. I'm hoping that we can get off this webinar today within 45 minutes. But Ali's got some broad experience working in domestic and cross-border and international tax matters. She's spent over 20 years in public accounting, tax, and estate planning. I personally love Ali. She's great because she's as passionate about philanthropy as I am. We both sit on the advisory board at Sick Kids, where she's the chair. She's the chair at the Jewish Foundation Professional Advisory Committee, where I was the chair. She took over from me, and is involved with countless other charities. So let's take advantage of her knowledge and wisdom today and find out what's going on with regards to AMT. This last budget, Ali, it seemed like it was so innocuous, like nothing was really so, fall off the chair. It just seemed, oh, the government was sort of putting forward some things that were pretty benign, right? Until some deep dive investigations went on, and we found out that there's a significant change to something called the alternative minimum tax, the AMT. I don't think too many people know what that is or the origins, and I thought it would be a great idea to start off with just what is this alternative minimum tax, the AMT, and we can go into it from there.
For sure. Thank you so much, Mark. And first of all, of course, thank you for having me. I am excited to be here. I get very excited talking about tax and estate planning, and especially when it comes to philanthropy, for sure. I just want to mention, Mark, I'm not able to see the questions. So if any questions come through that you think would be great, if you wouldn't mind just bringing those to light. I'm having a little bit of technical difficulties today.
Yes, I will get. I'll definitely get those for us. Go ahead.
Fabulous. Okay, great. So what I'm going to talk about now, really, as you mentioned, is kind of the history of AMT. What is it? Was it a big deal? How did it matter? We'll talk about the past of it. So AMT, alternative minimum tax, has actually been around for about 40 years. It's not something new. It's not something new. Tax practitioners have always thought about it, considered it, and I'll give you some examples of when it's creeped up in the past. But I would say that for the average typical person, the average typical taxpayer, AMT really wasn't a thing. It wasn't something that showed up on your tax return. And to be honest, for the average typical taxpayer, I'm still not sure that it will in the future. But let's talk about what it is. My understanding, this is not my story to tell, but I've heard that AMT is really a spite legislation that was introduced because they were upset because there was some noise in the community that people weren't paying any income tax, and the government didn't like that very much and said, well, let's put in this minimum threshold of 15%. So historically, it was a minimum 15% tax that was applied to a computation of income different than the way that we would calculate income for regular income tax purposes. And maybe I'll explain that a little bit. So when we file our tax return, when we comply with income tax legislation, we compute our income subject to tax according to the rules of the Income Tax Act, and out pops a number. Out pops our regular income tax number. What's happening when we do that is there's actually a calculation running in parallel. And when you're entering information into your tax software, something is going on behind the scenes where this parallel calculation is happening at the same time and is determining not just what your regular income tax would be, but what would your alternative minimum tax be. In most cases, your alternative minimum tax results in a lower tax than your regular income tax. And if your regular income tax is the higher of the two, minimum tax would not show up on your tax return. In certain circumstances, and we'll talk about when it would apply, but in certain circumstances, this calculation would run in the background and would actually result in a higher tax than the regular income tax. And to the extent that there was a delta or a difference, that additional amount would show up on your tax return as an amount of tax that you would have to pay. For example, if regular income tax was calculated at $15,000, AMT was calculated at 20, the difference, the increase, the $5,000 would show up as a minimum tax amount on your tax return. What minimum tax was really looking at getting at? It was looking at items of income that were taxed very preferentially. So for example, if somebody was using their capital gains exemption, perhaps they sold shares of a small, not small, but they sold shares of a Canadian private business. They were able to shelter, let's say, up to almost $1 million of tax on the sale of that business because they claimed their capital gains exemption. That is something that was very important in the alternative minimum tax regime because notwithstanding for regular income tax purposes, you may not have to pay any tax. Under the AMT rules, there may have been a minimum tax that you had to pay. Without getting too technical and into all of the technical points, what it is important for me to also highlight about minimum tax is that I always saw it as a professional as an anti-deferral tax. If minimum tax was paid in any tax year, and this is still true today, if minimum tax is paid, it is creditable against regular income tax in the following 7 tax years. So if we ever had a client with, I don't want to call it an oops or a surprise, sometimes we knew minimum tax was going to hit, but if we ever had a client who had a minimum tax burden added to their tax return, we always made sure as advisors, if it was possible, it's not always possible, but if it was possible to make sure that the taxpayer would have high rate sources of income such that in a future year, they would be able to use that minimum tax they paid in one year against the their regular income tax otherwise payable. That's why I call it a deferral or an anti-deferral tax. It's making you pay tax up front that you can otherwise claim back over 7 years. As I mentioned, not always possible to claim it. It depends on the, the certain, claim it back depends on the certain circumstances and the type of income that you have. But that's what minimum tax is. That's what it historically has been, and that's when we've seen it hit.
Perfect. So that's great. Thank you for that background. And my understanding is that it's only really impacted about 30 to 40,000 Canadian taxpayers up until now. They've only been subject to it. And obviously, with this parallel system and the changes, you're going to have now more people being affected, and the people who were affected being affected in a much bigger way, especially for people who are going to be thinking about having liquidity events like selling a business or making charitable donations. That's fantastic. So what actually is the change now?
Sure.
Maybe you could just give us an idea of like what did the government propose? Because I know that they are trying to address more inclusion of exactly as you said, taxpayers getting this income that's not fully taxable, dividends, capital gains, etc. And they're trying to make it more a levelized playing field, but it's going to be a net that catches way more people.
Yeah, that's a really good question. So there's three things that have changed. So number one, the absolute rate of tax that is minimum tax has increased. Historically, it was at 15%. It's now at 20.5%. So right, so
So the
15%.
AMT it was at 15% and now it's
Correct.
going up to
Yeah.
20.5.
The AMT, and this is federal only, I should mention. Provinces generally tack on to the federal system, and I have to assume that the provinces will follow suit. So when I'm using these numbers, these are federal only, but they actually will be larger numbers because
Provincial.
the provincial will follow suit. So we're going from a 15% rate to a 20.5% rate. Um, we're also They are also changing the way that the taxable income for purposes of the AMT computation is changing. And this is really, really key, and why we're gonna find that so many more people are going to fall into this net. Some of the changes, for example, whereas before, I'm looking at some of my notes. What some of the changes are. Whereas before, when we had a capital gain, for example, when we had a capital gain, I'm not talking about specifically in a donation plan, but when a Canadian individual had a capital gain, we know that for income tax purposes, the gain is only half taxable. Only half of it comes into the computation of taxable income for purposes of income tax. For purposes of the AMT, historically, 80% of the gain did come into the computation of taxable income for purposes of AMT. However, now 100% of the gain is going to come in to the computation of tax for the purposes of AMT. And without getting too bogged down into the numbers, what's really important, and I don't think that a lot of people realize yet, but for taxpayers who are going to be subject to this AMT, effectively the personal income tax rate on capital gain income in Ontario, for example, has changed from about 27% to closer to about 33%. And that's because AMT will kick in on large gains. You had mentioned selling a business. We can talk about that after. AMT will kick in, and the AMT will be the higher of the two taxes, the income tax or the AMT. That's something that's not getting as much press. I'm surprised. I think as the year goes on, we'll see more and more. The point, so various things changed. Again, that's in the computation of the base that's subject to the AMT. What also changed is the exemption amount. So historically, $40,000 of taxable income was exempt from the AMT rules, and the government has raised the exemption. They've raised the exemption up to $173,000 per year, and under the proviso of, well, we're making sure that people who have income between $40,000 and $173,000 won't be subject to the AMT, which is great. It's
Hmm.
true. But to be honest, in our world of high net worth clients, ultra high net worth clients, major donors to organization, the change in the exemption is, I don't want to say meaningless, it's not meaningless, but many, many of our clients have incomes in some years or in certain years that are well in excess of the $173,000. So It is important because it'll keep some people out of the AMT net, but the high net worth population will definitely be caught.
So the average guy on the street, the civilian, somebody who's just call it an incorporated doctor, or somebody who's just a salaried person making a couple $100,000 a year. So those people would be out of that sort
They
of
would
that catch
probably be out of the right.
the
It
catch.
depends on what their taxable income is at the end of the year, but they'd be out of the what I'll call the goalposts of when AMT applies.
Good.
Mark, one thing I think I just want to talk about this now. One thing that's very important. Maybe I'll specifically discuss some of the changes that are important in the world of philanthropy. I want to make sure that I mention these. Of course, we're here to talk
Don't
about
worry, I will
philanthropy
make sure that you
on
do.
Philanthropy
Yep.
Fridays, but there's two very, very important, or one super important change and one that we'll tack on with respect to how this impact donations and with respect to the changes. So historically, when we talk about under income tax rules, when we had a share of a public company that had an appreciated gain within that share, for example, you bought a stock for $1,000, it's grown to $5,000, and there's a $4,000 gain in that stock. We always knew, and I'm sure you and I were always telling our clients, the easiest way to make a donation of non-registered public company shares straight to the charity. It's as easy as calling up your broker, having them find out the details of the brokerage account of the charity, send the money across, you're done. And the beauty of it was that there was no Canadian income tax on the capital gain included in that stock. It was amazing. You didn't have to, you would never have to pay the embedded tax within that stock gain, and you would get a full donation receipt that you can use to offset other sources of income. It was fantastic.
It's always shocked us that so many people in Canada are still giving cash checks and credit cards, which is the most inefficient from a
Correct.
cost and tax point of view. So make
Correct.
a note of that. You still want to donate securities, it's still a good thing to do.
Still important. However, in the past, where you and I could say to clients, this is a great way to do it, there's absolutely no income tax on that gain, the AMT regime or the AMT rules have changed this. Now, what's going to happen is that before, the inclusion rate for AMT purposes of that gain was also zero. It mirrored income tax. However, now the inclusion rate, the amount of that gain that will be pulled into the base for AMT purposes, is now 30%, which means that depending on the individual's specific situation in a given year, looking at all of their sources of income and how large their donation of an appreciated stock is, they absolutely may have a tax burden, an increased tax burden from giving that gift of stock, for example, in 2024, when these rules are purported to kick in, versus 2023. So that absolutely could be a change.
And do you think that will prevent people from wanting to take full advantage of obviously using charitable donations to mitigate some of their tax?
I think I don't know that it'll stop people from doing it. I think that it may dampen people from doing it. I think that when people realize that they thought that they had, I think that the challenge will be if they still want to give away $5,000, they may still give away the $5,000. We talk about the stock that had appreciated. However, they may have to hold back some of the $5,000 that they would otherwise give away, because some of that money is going to have to be directed to the CRA as opposed to fully being directed to the charity.
Wow.
So the how it plays out will be interesting. I do expect there could be a dampening of funds available to go to the charity. Couple points I want to note. We talked about the exemption limits. We talked about who this applies to. I really do want to drive home that we're talking about people who are what I would call ultra high net worth, who are giving away not the $10,000 perhaps, the hundreds of thousands of dollars, the millions of dollars. There are absolutely people who give away at that level of wealth. And this is where these rules are really going to affect the most.
So for the charities, and we have a real mixed group that's on this call. We have advisors, we have charities. So it's really the charities should be addressing this to their higher net worth or ultra high net worth donors, or people who've been very partnering and generous with them, to let them know, obviously, because it will impact them going forward. So the good news is there are things they could be doing for 2023. We'll come back to that shortly.
Yeah, the other thing I want to make note of as well. And similarly to what I was just discussing about the donations of appreciated stock, for people who have options, if we have clients or donors who have significant portfolios of stock options, There was a great planning tool whereby if you exercised and then donated within 30 days, it was possible, depending on the facts and circumstances, but it was possible to also bring the tax rate down to zero on that stock option benefit, which was amazing. That will still fall into these new rules. It might not be as attractive. And then, of course, with respect to flow through shares, many clients do look to flow through shares to magnify philanthropy in certain ways. Whenever we work with clients who are using flow through shares to make donations, I sometimes refer to it as goalposts. We look and say, well, based on your income for this year, how much can you donate, whether it's donations or using flow through to make those donations? How much can you do before this AMT kicks in? Even though it's only an anti deferral tax, we never want clients to have to pay it. I don't want people to have to be out of money that they otherwise wouldn't have to be out until future years. And as a result of this, what I do expect is that the magnitude of giving will decrease if tax is one of the considerations based on how you give, because the amount of money that'll either have to, the amount that you would normally expect as a reduction of tax on your tax return will be different in 2024.
Well, I know that the good news statistics say that 2/3 of giving decisions to charity are based on people's passions they
Good.
care about, and only 13% has been predicated by tax. So it's not the tax tail that's been wagging the dog. It's
Right.
always nice once we have people who are passionate and also we can bring in the tax. That's
Yes.
how we can amplify that gift. So hopefully that won't be the case here. But certainly, we're trying to find ways for charities for it to be easier to give money to charity. If
Of
anything,
course.
we know so much is being pulled back from the government in terms of contributions to social welfare. Apparently, there are about 25 different pieces of legislation since 95 that were introduced to make it easier to give money to charity. We want to make it easier. We
Yes.
don't actually want to dial it down. So
Absolutely.
this will definitely have an impact. Again, it's yet to be seen, right? But clearly, we're in 2023 and it's 5 months until, January the 1st of 2024. Now, are these changes, are these in stone or are these proposed? Like, what's
It's
going on?
another great question. So right now, I have not yet seen draft legislation. Maybe it's come out this morning. I haven't seen it. We are anxiously awaiting to see what the draft legislation will say. So in budget 2023, it was a lot of words. It was a lot of commentary about it, about what was to come. And it did make reference to the fact that this would be implemented for 2024. So if the comments that we're making are really based on our interpretation of what they have said, in words, but we haven't yet seen the draft legislation.
Got it. So one of the questions that came up is on this subject. We've actually had a couple of questions, but somebody was wondering if there's anyone is doing any lobbying against this change, and is it still possible for it to not go through? And I know I've been a big spokesperson on this. I did a significant post on LinkedIn with some wording that we sent letters to Chrystia Freeland at Minister of Finance to have her reconsider this. And I
Yes,
think that this is going to require a bit of a groundswell from not only the professional community, but even more so from the charitable community. I know the Canadian Association of Gift Planners is trying to do something there as well. But hopefully, if we our voices are heard, we can get at least not all of the things rescinded, but at least when it comes to charity, hopefully bring it down to something that doesn't scare people away from being givers.
absolutely. And I do agree that in order to make change, there does need to be a groundswell of action, of movement to make sure that that our voices are heard, and that both from the donors and the charities perspective. Absolutely.
So somebody also had a question on the
Mhm.
$173,000 exemption. Is that net per family income or is that
No,
individual?
that is individual. That is individual per person. Absolutely.
Got it. So that
Absolutely.
can be multiplied obviously
Yeah.
among. Okay, good.
For sure, but it can absolutely be multiplied, but you need to have the income belong. You've got to consider the attribution rules and all that good stuff. You have to make sure that the income belongs to people.
So other than sort of this lobbying and sort of trying to make noise to get this rescinded, obviously we also have to pass along this information to the people that it makes most sense to. Obviously, professionals. Ali, you're a real spokesperson in this area. I know Jamie Gollenbeck from CIVC, who's also on many boards with us, speaks about it quite a bit. So we want to make that noise, but what sort of planning could be
Yeah.
done in 2023 to make it easier, at least to bypass some of these changes that we should be encouraging our donors, our serious, significant donors, and our clients?
That's a great question. Based on my understanding of the rules, I do think that there is absolutely an opportunity in 2023 to make sure that if we have clients who can plan for this, that they don't get stuck in the new AMT world, that they can live in the old world as long as possible. That can take on a few different ways. So number one, for clients who know that if they have certain pledges out there, if they know that they're going to be making donations over the next period of time, the next number of years, do they want to consider either fulfilling their pledges now, making good on their pledges, giving away all of the money now directly to the organization today? If they don't want the money to go directly to the organization today, do they want to use a DAF, a donor advised fund, or a foundation, a private foundation, to use to house their donative dollars today? Whereas, they can get their donation receipt today and then decide over time where the money is going. The one comment, though, that I want to make that's very important, this actually came up in a great discussion I was having yesterday. For clients who are going to front end their donations in 2023, what they also have to make sure is that they have enough income or maximum income in 2023 to soak up as much of the donation receipt as possible. It would be a bit of the plan wouldn't work as well. Like it would be great to make the donation in 2020, 2023, but if you make such a large donation and you don't have enough income to soak up that donation receipt, because we're limited to individuals to 75% of income for what I'll call traditional donations. 75% of income can be sheltered using donations. There's some tax you still have to pay. If your income isn't high enough, what will happen is that the unused donation receipt will get pushed forward. You can use it for up to 5 years. And if you push it forward, you'll be relying on the new AMT rules next year and the year after to calculate and see if you can use up that donation receipt. What I do find in the world of high net worth and ultra high net worth individuals is that they do have some control over their income. And what I mean by that is they do have the ability often to turn taps on and off from corporations, whether it's paying themselves salaries, bonuses. Salaries and bonuses are great from an AMT point of view because they're high rate, full rate taxable
And
income.
you
They
can get that
lessen
money back and you can
they
get that
lessen the
refund back.
it
Yeah.
lessens the burden of AMT.
Mm.
Dividends might help as well. Dividends are higher rate than capital gains. So if you are a person, or if you have a client, or if you have a donor who is considering, front ending a donation, whether directly to the charity or into a donor advised fund or into a foundation, make sure that that individual can use up or soak up all of that donation receipt in 2023, just so that you're matching the benefit and the use of the benefit in 2023, and we're not just punting the problem down the road.
Good. One of the things that I think is very important, and I'm glad you brought that up, that charitable donations can be used to mitigate up to 75% of your net taxable income payable.
Yep.
And what people are less aware of is that on death, charitable donations can be used to mitigate up to 100% of estate taxes, and you can go back the prior year. Which
Yes.
the good news is that AMT apparently is
Yep.
not going to have impact on terminal estate planning.
That is
Correct?
an excellent, excellent point, and something that I usually say at the beginning, and I forgot. So thank you for saying it. AMT does not apply in the year of death, which is very important because that's when individuals often have a large realization of assets, or a large realization of tax that's been embedded in those assets. So you're absolutely right. In the year of death, you can use donations to shelter 100% of your income. You can go back 1 year, and you're absolutely right. AMT would not apply in the year of death.
I know that for our firm, we're on a mission that every professional in Canada should be incorporating strategic philanthropy into clients' estate planning. I
Yeah,
mean, there's just a great opportunity for them to obviously convert taxes into charity, create enduring legacies, but so few advisors are actually engaged with this, which is a real shame. Hopefully, Ali, we're trying to, by having calls like this and speaking
yeah,
to charities and donors, that we can actually move that forward. But that's really important to know, that people do have a choice where their taxes go. They can go to, their money can go to family, they can go to the government, and to charity. And each of us can pick two of those. Most people would take family and charity. So hopefully we can get around to that. I have another
yeah.
question for you. Um, Obviously the donating of appreciated securities, even though it's remarkable how few donors and charities are actually doing things with appreciated securities, it was a very easy conversation to have, very kind of simple,
Yep,
right?
very
and
simple.
and once people got it, it was like an aha moment, and they went, wow, I've got mutual funds, stock, ETFs, whatever the case might be. That's not changing so much, right? Like for the average person who's going to give that $5,000 of stock or their mutual fund,
I would
people are
agree with that.
concerned.
Yeah,
People are concerned that this is going to stop, but it's not. Correct?
I totally agree with you. For the average donor, I haven't defined what average donor is. I don't know that I have a definition, but for a typical person, this is not going to impact. Where this is going to impact is the person who is otherwise going to give away in the tens to hundreds to millions of dollars, or hundreds of thousands, tens of
Hundreds.
thousands, and millions of dollars, who is using that to fund very, very large donations. What we've seen, there's a great article. Jamie Gollenbeck, just I know we were talking about him. He writes some fantastic articles. He just released it actually today, his second follow-up point, which goes through a very interesting analysis, which looks at, in particular, a business owner who is selling their business personally. When they sell their business personally, it shows the impact of AMT kicking in. It shows that, whereas before I mentioned, about a 25% increase in the tax rate from the 27 to the 33%. And then it also shows that if they couple at the same time, often what we see with clients who have liquidity events, that's the time that they're prepared and they want to make that large donation to either, to leave a legacy, to fund a donor advised fund, to fund something that's going to work for, as part of their estate planning, perhaps when they pass away in the future. We often see large decisions being made around the time of the sale, and what is a challenge is that the coupling of the donation, first by cash coupled with the sale. It's even worse on the AMT side. And then if you choose to use appreciated stock to fund that donation coupled with the sale of a business, it's like really bad. Like, it's wild. The numbers, that the increase in immediate taxation is
It's huge.
wild.
Yeah, Jamie,
Huge.
I
Yeah.
outlined that. Very scary.
Yeah.
Well, one thing is for sure, sometimes bad news is bad news, but bad news can also be very good news. The
Mhm.
fact is that this is not good news, but it's newsworthy to be able to at least have the conversation now with people.
Yeah.
Maybe this is the opportunity to talk about donating appreciated securities where you, as a charity, you never did it before, and that will open up sort of the floodgates to other areas. But certainly when it comes to selling a business or selling some investment real estate, we know that that year is your greatest payday. It's your greatest tax year, but it's the year you can be your most generous to
Yes.
mitigate that tax. So one of the questions that came up is, you know, people who are thinking about selling their businesses, doing it this year versus next year, like, should they be getting advice
Yes.
today
Yes. Yes.
to
Yes.
look at
Yes.
doing this
For sure.
transaction in 2023?
There absolutely could be reason to, and I want to stay away from making a blanket statement, but I would say absolutely the structuring of the sale of the business should be considered if there is something to be done in 2023, or if there is a different way that the business sale should be structured. Um, Without the draft legislation, it's hard for me to guess what's going to be there. It could be it could be that one of the ways to mitigate some of this risk is to perhaps transfer the shares that you own of the business into a corporation and have a sale at the corporate level. Corporations don't face the same alternative minimum tax that individuals do.
Good.
There
That was
may
one of
be
the
setting
questions we
points.
just had. Does AMT apply to
Yeah.
corporations?
So AMT does not apply to corporations. There's the old capital tax for those of us who have been around long enough to remember the capital tax calculations, which was literally a tax on capital. There are also provincial minimum taxes that can apply to very, very, very large operating businesses or other types of businesses. But you know, I see them apply so rarely, the corporate minimum taxes, it's not even worth discussing at this point. But definitely in the individual and trust world. So it's not just individuals, trusts, and estates. AMT will be applicable for sure.
So one of the questions that came up, somebody just asked if you would be so kind just to go over again. If they donate in 2023,
Yep.
right? So they're not impacted by the AMT, let's say in
Yep.
2023. And let's say they dispose some stock or whatever, and we put it into a donor advised fund or a
Yep.
foundation. So how might that impact capital gains triggered? In other words, how might there be some problems with that with AMT going forward? Like, in other words,
Sure.
yeah.
Sure. So if the numbers are large enough, what could happen is that the person who makes a large donation of appreciated stock in 2023 would have no income tax effect on their tax return. They wouldn't owe any additional income tax. And in fact, they would get maximum benefit. The gain is completely non-taxable, and they would get a full donation receipt. In 2024, what will happen is you will still get the full donation receipt, but a portion of the gain, right, 30% of the gain, not 50%, but 30% of the
Will be
gain
taxable.
will
Will be
be
part of,
taxable.
right.
Will be taxable. And so I'm going to do some quick math, 30% times 20%, there will be, whether it's 6%, but there will end up being a tax, a minimum tax on that gain that you otherwise wouldn't be paying in 2023, but you will be paying in 2024. So you may have so let's say you have a person who that all they do is they make this very, very large donation of appreciated stock in 2023 versus 2024. In 2023, you will not end up with any taxes owing. In 2024, it's there's so many factors into this, but it's fair to say that the net tax benefit in 2024 will be less than it would be in 2023. That's probably the easiest way of saying it, because a portion of that gain, 30% of that gain has now become taxable for AMT purposes, whereas it wasn't for 2023.
Got it. Okay. I'm sure more will come out to help us understand this. I did see an article that was in the Globe and Mail by Tim Sesnick of our family office. I
Yep.
don't know if you got a chance to see that, Ali, but just on the responsibility of some of the community foundations that are going to have to now submit at costs
Yeah.
certain documentation around these trusts,
Are you
and that
talking?
if they don't, there's going to be a big smack, a penalty that could be tens of thousands of dollars. Can you just bring that up for a moment? Because this is another
Yeah.
reason for us
Sure.
to be doing this lobbying now, because it could be really
Yeah.
detrimental.
So I totally know what you're talking about. It's a bit of it's a total pivot from this discussion, but it's very important for us to have this discussion. Tim Sesnick did write an article in the Globe and Mail, I think it was yesterday, about it. Effectively, starting in 2023, all express
2024 or 2023?
so starting for year 2023,
Good. Yep.
required in the first quarter of 2024, but for the year 2023, all express trusts will have to file tax returns. There were many reasons why an express trust, it's a legal term, I'm not a lawyer, I'm not going to get into it, but there's many reasons why many trusts didn't have to file in the past. All of these trusts are going to fall into the filing requirements in 2023. There is some concern that the relationship between a donor and a charity, where the charity, and again, if I say something out of turn here, forgive me for using the legalese as an accountant, but the relationship between the donor and the charity, where the charity is holding funds for a future use as directed by the donor, is that an express trust? And if that is an express trust, does that mean that the charity, whether it's a community foundation that has many, many, many donor advised funds with it, or whether it's a regular charity that holds, funds, like restricted funds for certain specific uses, do all of those relationships with donors become express trusts, meaning that the charity, the obligation I believe would be on the charity, will have to then file specific T3 trust tax returns for each of these relationships? It's mind-boggling. I think it's bananas.
These foundations have so few employees
I
already.
know
They're already
it's not
strapped with
feasible.
resources. It's
I
just, I
was
can't imagine.
I was just going to add to Carter's, a law firm that specializes in philanthropic law, also put out a bulletin, I believe it was on the 27th, that addresses this issue and whether or not it applies or it doesn't apply. I haven't read it in detail yet, I'll be honest with you. I'm going to leave it to the lawyers to sort through this one. But if you are involved with a charity, if you are a charity yourself, this is absolutely something that you need to be familiar with very, very quickly, because the the reporting obligations, I can't even begin to express how burdensome it
Oh
would
my
be.
gosh. Oh
So
my gosh.
let's not even never mind. We're not going to find the accountants to help you do them because no one's going to have time. I guess maybe you'll be doing them in house. We'll leave that for another day. But it's very important that you brought that up.
Would that include endowments as well, Ali, do you think?
It very well could. I don't. I honestly. I
Okay,
don't
right.
know
It's
for
we don't
sure,
know.
but
Yeah,
it very
we'll
well
see.
could. Yeah.
Right. So obviously with this information and the time sensitivity, etc., I'm assuming you would agree that we would likely see a good opportunity for an increase in donation of appreciated securities
Yep.
in 2023, and that's something that people should be looking at. Look at if any charities are listening, which we know there are, or professionals, and you know that you have clients who have big appreciated non-registered securities portfolios, at least have that conversation, and certainly have the conversation with any of your major donors who've just been giving you cash checks and credit cards or have been giving you stock, to go ahead and tell them this is the year, and put them in touch with their professional, or they can reach out to Ali or me or whatever. Or what we could do is we could actually do another webinar just for donors of charities. I lost you there, Ali. We could have a webinar just for the major donors to give them a clear understanding of the lay of the land and what's going on right now. So I think that would be a great thing as well. There you are. You're back.
I'm back. Sorry.
Good. So I think that would be really important because it's a very time sensitive situation. That's for sure. I just want to be wary of time, and maybe we'll just sort of wrap up. I want to see if there are any more questions. I think there were, but just in terms of the wrap up, you know, the question is, where do we go from here?
So
Where do people go from here? Like,
yeah,
it's a lot of information.
it is a lot of information, and it's a very hard area to apply in broad strokes and say if this then that, if this then that. The key here is that if this is going to apply to donors, to taxpayers, each individual situation is going to have to be looked at on its own facts and determine what the best course of action is. But it is important. Now is the time to be having those conversations with clients or donors to talk about what the plan is going to be. And certainly, I think that there'll be a flurry of activity. Perhaps Mark, you and I can come back on and do another one when we see the actual legislation, and we can actually digest and understand what this is going to mean and how it's going to play out.
I think that's a great question, a great idea. And yes, well, this is going to be a moving target. It's going to be a process. It's not going to be an event. Just
Yes.
to clarify again, Ali, because I know that I have many people who are making a few $100,000 a year, 200, 250, 300, and they're worried about how's this impacting them. So the question is to clarify the proposed change to AMT income tax on 30% of capital gains of donated appreciated security will only be in effect in 2024 for
Correct.
those who have income above $173,000. Is that
Correct.
correct?
That so far what I'm hearing is correct. Yep.
Beautiful. Good. I just wanted to make sure. Look at, the highest marginal tax rate, federal rate right now is what,
It's
33.5%?
33% federally. Yeah.
Over. And what's the benchmark for that? Somebody, I think it's
Oh, it's about
230,000 a year.
yeah, it's about $225,000 a year. Yeah.
Okay, good. So certainly we'll continue this conversation. If any charities would like to have engage a conversation with their major donors, I'm sure Ali, you could make yourself available. You're not
No
you're not
problem.
busy enough. No problem. We can do a shortened version. And I really believe I call it like the 48-hour rule. If one idea came out of this that impacts you and you really feel that you have to move on, put it into some sort of plan of action in 48 hours. Otherwise, you know what happens, wonka wonka, we forget, it's on to sort of the next thing. And reach out to Ali or reach out to me, and we'd be very happy to help. This area of strategic philanthropy in particular, as I said, is just not so well known. There's amazing planners that do great tax stuff up until this point, but there's an entire shelf above
Yeah.
dealing with philanthropy that most people are not aware of, and we really do want to make sure that we get to people and help educate them as much as possible. Any final words, Ali, before we sign off?
I hope everybody has a wonderful weekend.
So do I. So I want to thank everybody for joining us today for another segment of Philanthropy Fridays. We'll be having our next session in 2 weeks' time. I know Cindy will probably put something in the chat in terms of what the subject matter is and who the guest is. So please join us. If you have any questions, please send me an email, mark@WealthInsurance.com. You can reach out to us. And if you need help around the build out of your strategic plan legacy giving program at your charity, we love to share intel on what others are doing and how we can help you integrate that into your planning as well. And Ali, thank you very much for joining us today.
With pleasure.
It was great. Thanks very much, everybody. Have a great weekend.
Bye bye.
Thanks for joining us today. Bye-bye.